Imagine you're just looking at a scoreboard at the end of a game. There's this expectation of, absolute finality.
Right. You cast your ballot, the polls close, and boom.
Exactly. The anchor on TV points to a map and says, hey, there's your winner. Red or blue. It's clean, it's comfortable, and it's settled.
Yeah, I mean, we genuinely crave that categorical neatness. We really want our civic events to fit neatly into just, victory or defeat.
But then you step into the world of high-leverage political prediction markets, and suddenly that simple scoreboard it shatters into a million real-time data points.
Oh, totally. We aren't just looking at who wins anymore. We're looking at a deeply complex financial ecosystem.
And that actually brings us to the focus of today's deep dive. We are setting the scene for you right now. It's June 2026. The California gubernatorial jungle primary just wrapped up on June 2nd.
Which was huge, yeah.
Yeah, and it has left us with a very clean binary showdown for November. Democrat Xavier Becerra versus Republican Steve Hilton.
It's a textbook matchup, really. You've got the political establishment versus the populist insurgent.
And here is the twist for you listening today. We aren't looking at this race through the lens of a traditional political pundit.
No door-knocking strategies here.
Right. We aren't going to talk about yard signs. We are looking at it entirely through the eyes of a leveraged prediction market trader. Like, how do financial tools turn a political campaign into a tradable asset class?
It's wild because it forces you to completely abandon your normal political vocabulary. You stop talking about, voter sentiment, and you start calculating volatility premium.
And mean reversion, right?
Exactly.
Now, before we go any further, I really need to set some strict ground rules for you. The information we're analyzing today involves a lot of politically charged content.
A lot of it.
Yeah. We are going to examine left-wing platforms like Xavier Becerra's tenure at Health and Human Services, fighting the Trump administration. And we're also going to examine right-wing platforms like Steve Hilton's conservative economic policies and his endorsement from Donald Trump.
Right.
Let me be incredibly clear about this. Neither of us is taking a side here, and we are not endorsing any of these viewpoints. We are impartially reporting the fascinating financial and strategic analysis contained in the original data.
And that is a vital distinction to make for this deep dive. To a professional trader, these political platforms are simply variables in a mathematical equation. We are purely here to look at the math.
Okay, let's unpack this. Let's look at the two main assets, or I guess candidates, that traders are evaluating right now. What does the baseline reality of this market look like as we sit here in June 2026?
Well, looking at the Polymarket odds, the landscape is violently skewed. I mean, Xavier Becerra commands a massive 88.9% implied probability of winning the governorship.
Almost 89%.
Yeah, and Steve Hilton sits at just 9%.
So if we translate this into stock market terms, Becerra is your classic blue chip stock.
Yeah.
He's the boring, reliable, slow growth index fund.
Right, and Hilton is the highly volatile, high-risk, high-reward tech startup.
But wait, if Becerra is sitting at nearly 89%, isn't that like a terrible place to tie up your money? I mean, the math doesn't seem to offer much of a reward. Moving from 89 to 100 barely moves the needle on your portfolio.
What's fascinating here is the concept of baseline partisan gravity. The raw, unleveraged upside is indeed really small.
Right.
Moving from an 89% probability to a 95% probability is only about a 7% gain on your position.
Which is nothing for a trader.
Exactly. But for a professional trader, that 89% represents incredibly high baseline confidence. The structural reality of California means fragmentation was Becerra's only real threat.
Oh, because he faced a crowded Democratic field in the primary.
Right, which carried the risk of splitting the vote and knocking him out of the top two entirely.
But he consolidated the party establishment vote, emerged cleanly, and simply evaporated that fragmentation risk.
And once that risk is gone, traders view that 89% as a fortress. Plus, Becerra has historical momentum driving his valuation.
Right. If he wins, he makes history as the first Latino to win a major party gubernatorial primary in California.
Exactly. The market prices in that structural demographic advantage as deep stability.
So buying Becerra is essentially betting that political gravity still works. But let's pivot to the volatile tech stock. Let's look at Steve Hilton.
Yeah, Hilton's a wild ride.
Right. He placed second in the primary with 26.4% of the vote. And his stock price, his implied probability, surged from 6% to 9%. How does a trader justify that 50% jump in value?
Well, Hilton is attempting to nationalize his campaign around very specific localized kitchen table issues. He's advocating for cutting gas prices by suspending environmental regulation.
Which plays well in certain areas.
Yeah, and he's pushing middle-class tax cuts and talking about opening up natural spaces to build suburban housing. Those issues resonate heavily in the Central Valley and the inland exurbs, regions that have drifted rightward.
But that strategy runs headfirst into what analysts call the classic blue state endorsement trap.
That is the structural ceiling on Hilton's price. Back in April, Donald Trump endorsed Hilton. In a Republican primary, that endorsement is pure gold. It helped Hilton consolidate the base, especially after his main rival, Chad Bianco, dropped out.
Which secured his second-place spot.
Right. But in a California general election, that gold instantly turns into lead. Disapproval ratings for Trump sit around 69% in the state.
So Hilton is trapped in this, impossible financial position. He needed the Trump brand to survive the primary. But that exact same brand effectively caps his upside in November.
Exactly. The market looks at that dynamic and keeps him pinned at 9%.
But we need to move from political strategy to pure financial mechanics here. Because moving from 6% to 9% doesn't sound like a windfall to the average person.
No, not at all.
So how are people making actual fortunes on these tiny margins?
This is the crux of the entire leveraged trading ecosystem. A platform like Polymarket is incredible for probability discovery. It tells you exactly what the crowd thinks the odds are.
But Polymarket offers no native leverage.
Right. If you put in $1, you are trading on the movement of that single dollar. To make real money, you have to look at margin accounts.
Which means looking at platforms like Predmart, where traders are allowed to use up to 5x leverage.
Yeah, that's where the magic happens.
Walk us through how that leverage physically changes the math for someone holding a Hilton position.
So let's say you correctly predicted Hilton's primary advance. You bought his contract when he was at a 6% implied probability. After the primary, he jumps to 9%.
Okay, so on a normal exchange, you just made a 50% gain on your position.
Right. That's a great week. But at 5x leverage, you are borrowing capital to amplify your position size. That same 3-point move now delivers a 250% return.
Like 250%.
Yeah. In 1 week, you have more than tripled your initial investment simply because a candidate moved from virtually impossible to slightly less impossible.
That is wild, and it works on the blue chip side too, right?
Absolutely.
If you buy Becerra at 89% and he slowly creeps up to 99% as election day approaches, that's an 11% unleveraged gain. But at 5x leverage, that slow, boring, inevitable march to victory yields a 55% return.
It does. But, and this is a massive, but that leverage cuts both ways.
Yeah.
We have to talk about margin calls.
Oh, right. Because you're playing with borrowed money.
Exactly. If you use 5x leverage to buy Hilton at 9% and a terrible poll comes out dropping him to 7.2%, you haven't just lost a little bit of money.
You're wiped out.
Yes. A 20% drop on 5x leverage means your entire initial equity is wiped out. The platform automatically liquidates your position to cover the borrowed funds. It is a ruthless environment.
Here's where it gets really interesting. With Hilton sitting at 9%, traders aren't just betting on him to win or lose. They're playing a two-sided trade.
Yep.
How does a trader look at a 9% probability and see two completely different opposing ways to make money?
It comes down to two divergent philosophies: trading momentum versus trading mean reversion.
Okay, explain the momentum side first.
The momentum trader looks at Hilton at 9% and says, hey, he has a clear economic message on gas and housing. He's going to catch fire in the suburbs and climb to 12%, maybe even 15%.
So they buy, hoping to ride that upward wave and cash out before November. And a move from 9% to 15% at 5x leverage is roughly a 330% gain. That is a massive payday.
It's huge. But the other side of that coin is the fade trader.
Right, the mean reversion crowd.
Exactly. The fade trader relies on mean reversion, the financial gravity that says extreme outlier movements will eventually snap back to their historical structural average.
So they look at that exact same 9% and see a bubble.
Precisely. They say, this is a temporary primary overreaction. The structural reality of California and a 69% Trump disapproval rating will hit him like a freight train.
So the fade trader aggressively shorts Hilton, betting he will drop back down to his historical average of 5%.
Yeah, and shorting him from 9% down to 5% with 5x leverage yields about a 220% return.
You are literally making a fortune betting that the loser is going to lose even harder.
It's brilliant, but tying up your money in these bets comes with a massive cost.
Right. If I'm locking up all my cash in a highly likely Becerra win just to get that 55% return, I can't use that capital anywhere else for months.
And that brings up the vital concept of capital efficiency. Tying up thousands of dollars in a Becerra position means You are parking your money for months. You suffer the opportunity cost of committed collateral.
Because you can't be nimble.
Right. A smart trader is constantly asking if that capital could generate higher returns if kept liquid to trade the day-to-day volatility of the race instead.
Which actually brings us to the most baffling part of this entire market. We've talked about Becerra and Hilton, the only two names on the ballot for November.
The only ones left.
Right. But I'm looking at the rest of this board, and there are 7 other names trading at tiny fractions of a percent, like between 0.05% and 0.15%.
Oh, the chaos bets.
Yeah. Tom Steyer, Rick Caruso, Alex Padilla, Antonio Villaraigosa, Katie Porter, Eleni Kounalakis, and Betty Yee. Why on earth would anyone put actual money on candidates who've already lost or aren't even running?
Because they aren't predicting a victory, they're buying lottery tickets on chaos.
Okay, what does it actually mean?
A trader buying these contracts is betting on a black swan event. They're betting that a massive scandal drops, a sudden health crisis occurs, or some unforeseen catastrophe forces either Becerra or Hilton to drop out entirely.
Which would trigger an emergency replacement process by the state party?
Exactly. And the math on this chaos betting is just completely insane.
Well, it really is. If you buy a contract at 0.15% and some crazy rumor causes it to jump to just 1%, that is a 567% position gain.
It's massive.
And with 5x leverage, you are looking at roughly a 2,800% return.
Yeah, you can throw $10 at a catastrophe and walk away with hundreds. And it requires so little capital that it doesn't hurt your main portfolio.
But help me understand the mechanics of this. Tom Steyer spent $215 million, got 21% of the vote, and conceded on June 9th. Under California's top 2 rules, he is legally barred from being on the ballot. Why is he still priced?
You're seeing a mix of algorithm quirks and blind chaos betting there. Automated market makers often keep fractional prices alive simply because there is always a tiny bid from someone hedging against a literal rewriting of election law or a catastrophic legal challenge.
Wow, okay.
But the more sophisticated chaos bets require looking at the actual party mechanism for a hypothetical replacement.
How does that party mechanism separate a good chaos bet from a bad one?
Well, if a candidate drops out in late September, the party central committee has to convene to choose a replacement. They don't just pull names out of a hat.
Right, they need a sure thing.
They desperately need someone with existing statewide infrastructure, active donor networks, and fresh ballot recognition. That is why Eleni Kounalakis is a fascinating high-grade chaos bet.
Because even though she dropped out of the governor's race, she's currently running for state treasurer and advanced with nearly 37% of the vote.
Exactly. Her statewide campaign apparatus is fully operational right now.
So if Becerra suddenly had to withdraw, Kounalakis could plug her active network right into the governor's race overnight.
Right. Whereas someone like Rick Caruso, the billionaire developer, definitively announced way back in January 2026 he wasn't running. He has no active political infrastructure right now.
So he's a terrible bet.
Exactly the difference. And then you have Alex Padilla, a sitting U.S. senator. While he has immense name recognition, he is focused entirely on his own re-election campaign.
Right, the idea of him abandoning a secure Senate seat to parachute into a chaotic emergency gubernatorial race would create a second crisis for the party.
Yeah, they wouldn't risk it. So he's a terrible chaos bet. It's all about understanding the logistical mechanics of an emergency.
So a trader doesn't just buy in June and go to sleep until November. Time is risk, and nobody wants their capital locked up indefinitely. How do they manage their calendars? Like, what does a trader's timeline actually look like?
If we connect this to the bigger picture, leverage traders despise holding positions through dead periods.
Makes sense.
They operate around specific, known calendar events that act as catalysts. They establish their positions just before these windows open, and they exit based on the volatility that the specific event creates.
Okay, so the first major window on the calendar is September 1st, the FPPC Form 460 campaign finance filing deadline. How do traders play a paperwork deadline?
It's pure information trading. Traders aren't just looking at the top-line cash. They're looking at the burn rate and the origin of the funds.
Oh, they want to see where the money's coming from.
Right. They're specifically watching to see if national Republican money is actually flowing to Steve Hilton. If the filings reveal that the national GOP has written California off as a lost cause, Hilton's odds will compress even further.
But if national money pours in, proving the GOP wants to force Democrats to spend precious resources defending California, Hilton's price bumps up.
Exactly. So a trader builds a position in late August, waits for the filing to drop, captures the resulting price swing, and cashes out.
And then the next catalyst hits on October 5th, which is when vote-by-mail ballots start dropping in California.
This gives traders a real-time read on turnout composition. In California, the vote-by-mail electorate heavily skews Democratic.
Oh.
Traders will be calibrating their positions based on early return data trickling in from county registrars, comparing return rates to historical baselines.
So if Democratic ballot requests surge, it structurally confirms Becerra's advantage.
Right. But if turnout is sluggish, suddenly Hilton's path doesn't look quite so impossible.
Then we hit the October debates. And this is where the strategy is just totally disconnected from traditional politics. Because a trader playing the debates does not care who actually wins the argument on stage.
Not at all. Debates are incredibly high-variance events. A strong performance by Hilton could spike his contract 2 or 3 points. A major gaffe by Becerra could crater his.
So the goal isn't to predict the winner of the debate. The goal is to capture the volatility premium.
Exactly.
And a volatility premium is basically the extra price built into a contract simply because of the massive uncertainty surrounding an upcoming event, right?
Precisely. The market prices in the potential for chaos. You position yourself ahead of time. You let the price swing wildly as the pundits overreact in real time.
And then you take your profit from that violent movement.
Yeah, and you exit the position before the uncertainty settles back into a stable trend.
Okay, so the final major catalyst is November 3rd, Election Day itself. But traders aren't just watching the top of the ticket. The governor's race shares the ballot with a U.S. Senate race, all 52 House seats, and 80 state assembly seats. How does down-ballot data drive the governor's price?
Well, partisan enthusiasm flows in both directions. The turnout models, driven by highly competitive local House races, will dictate the broader environment for the governor's race.
Oh, I see.
If Democrats are showing up in droves for a brutal congressional fight in Orange County, Becerra naturally benefits from that localized surge.
But if Republicans are highly energized locally, it suggests the state might be more contestable than the baseline gravity implies, right?
Exactly, and that causes intraday price swings for the gubernatorial contracts.
So what does this all mean? When you zoom out, the 2026 California governor race is this incredible case study. You take something that looks like a total political inevitability, an 89% favorite, a state with deep structural partisan advantages, and through the lens of prediction markets, it transforms.
It completely changes.
It becomes a complex, highly strategic ecosystem of risk, reward, opportunity cost, and margin efficiency.
It fundamentally alters how we interact with civic events, but it raises a really profound, almost dangerous question that goes beyond the data we've analyzed today.
What's that?
If political prediction markets, combined with high leverage margin trading, truly become mainstream, will we eventually see political campaigns actively trying to manipulate their own market odds?
Oh, wow. I hadn't even considered that.
Think about the incentives. Could a campaign intentionally leak bad internal polling to the press just to temporarily drop their own candidate's price?
Wait, really? Just to tank their own numbers?
Yeah, because that orchestrated dip would allow aligned super PAICs or friendly institutional traders to buy up contracts at a massive discount right before a major planned catalyst.
Like a highly scripted debate performance.
Exactly.
Right.
When democracy becomes a financial derivative, the definition of a campaign strategy might change forever. We might see campaigns optimizing for trading volatility rather than just optimizing for votes.
That is a staggering thought to end on. Because it brings us right back to where we started. We want elections to be that clean, simple scoreboard. You look at the x-ray, you see the broken bone, the doctor says, hey, there it is. But in this new world of leveraged political trading, the x-ray machine doesn't just show you the bone. It lets you bet on the speed at which it heals, while 5 other people try to break it again just to short the medical bill.
That's the perfect way to put it.
It is messy, it is complex, and it is endlessly fascinating. Thank you so much for joining us on this deep dive. For you listening, keep questioning the information you encounter, and we'll see you next time.